All right. So the quiz results you got right away, but you'll see the quiz answers after midnight tonight. So you'll have full access. You'll be able to use them for review. Any particular questions you want to talk about as far as content goes? Anything in particular that was troubling you, challenging or frustrating?
Oh, the debit and credits, they're really starting to get very confusing.
All right, let's do a review of debits and credits. Glad you asked. And by the way, when you say question two, I don't know what question two is because they do on different exams have different, they're randomly assigned. So they flow in different. So question two on your exam might be a question four on somebody else's. Well, let me just do the big picture again. You've seen this diagram before, and you'll see it again. You've seen it in every class so far. What we're going to be doing is talking about the left to the debits, and the right, which are the credits. So when we look at debits and credits, that's all we get out of this, left and right. The whole point is that we see assets and expenses are normally a debit balance. They're normally lefted. Liabilities, equity, and revenue are normally credit balances. So if we look at something like cash, look at something like accounts payable, look like service revenue, maybe insurance or rent expense. When we're making our entries, we're going to left maybe insurance expense, and we're going to right cash, which is going to reduce cash. It's going to increase, or we're going to left insurance expense and right accounts payable. We're going to debit insurance expense and credit accounts payable if we're recording the bill. And then when we pay it, we'll left our accounts payable to zero it out, and we'll write our cash, or we'll debit our accounts payable, and we'll credit our cash. Just because cash is on the left doesn't mean we debit it all the time. All it means is if we debit it, it goes up. If we credit it, it goes down. So in the case of cash, debit to cash is an increase. A credit to cash is a decrease. If we're buying inventory, we might debit inventory, so we're going to increase our inventory. If we're paying cash, we're going to credit the cash to reduce it, or we're going to credit the accounts payable. Well, if we credit the cash, it's going to go down, the cash. If we credit the accounts payable, credit to a liability like accounts payable is an increase. So normal balances of our assets are debit balance, and if we debit them some more, they increase, or they get reduced with a credit. Our liabilities and equity accounts are normally a credit balance. If we credit these things, they go up. If we debit them, they go down. So if we try to think of debits and credits just as increase and decrease, you lose, I lose, we all lose. If you think of debits and credits, debits an increase to assets and an increase to expense, now we're getting someplace. If we think of credits as an increase to liabilities, increase to equity, or increase to revenue, we're on track. So you either have to memorize the right-hand side, the T accounts with the picture, or the left-hand side. Increase an asset with a debit, decrease an asset with a credit. Increase a liability with a credit, decrease a liability with a debit. Increase equity with a credit, decrease equity with a debit. Increase revenue with a credit, decrease revenue with a debit. Increase expense with a debit, decrease expense with a credit. That's the core, that's the crux. We're going to be getting into adjusting journal entries shortly. And with adjusting entries, you're going to need to know your debits and credits. So let's go through a couple of transactions. So if I go ahead and I'm saying, all right, let's go into, I'll go through here. So let's go and buy something. What do? First, let's say $5,000 worth of inventory. First thing you do is type in the numbers. Let's make it a little bigger so it's readable. We have $5,000 worth of something that we just bought. And we have $5,000 in credits. So we have 5,000 debits, 5,000 credits. So what are we doing with this? So if we bought inventory, $5,000 debit, what's that going to do to our inventory? Well, inventory is an asset. And if we debit an asset, it increases. Yeah, that makes sense. We've got $5,000 inventory. What are we crediting? Well, we've got a couple of options. We might pay cash for it. So inventory is going up, cash is going down. One asset went up, one asset went down. Our net effect on assets is zip. But what if we decided, I'm going to buy that same inventory, $5,000 worth, but I'm going to put it on account. So this time, one asset went up, inventory, one liability went up, accounts payable. Our total assets went up 5,000. Our total liabilities and equity went up 5,000, but we're still in balance. And then I pay the bill. So what happens when I pay that bill? I'm going to have $5,000 hit up somewhere, $5,000 hit up somewhere else. Am I going to add another 5,000 to my inventory? No, I didn't buy any more inventory. I just paid the bill. Did my cash go up or down? Down. Okay, is that a debit or a credit? Credit. So we're going to credit our cash for 5,000. Whatever the other account is, has to be debited. Now, based on the previous transactions, if you look up here, you say, okay, this is a second entry. Bought inventory and accounts payable. How much am I going to owe after I pay this bill? Zip, zilch, zero. I'm going to owe nothing. So I'm going to clear my accounts payable. Now, if you look at the T accounts, how this all forms up, we're going to look at our T accounts. Cash. Accounts payable. So I'm going to zap this transaction here. So we're worried about these two. We bought inventory and we owe the money. So we got $5,000 sitting in inventory. We got $5,000 sitting in accounts payable. If I didn't pay the bill at the end of the month, I can tell you accounts payable, I owe $5,000 to somebody. Inventory, I got $5,000 sitting in assets. But then I go in and I'm going to go ahead and clear my accounts payable with a debit and credit my cash, reduce my cash. So I've got these T accounts. I've got these accounts sitting there, my ledger accounts. These are the journal entries. These are the ledgers. Think of 1 page per T account. And that's where we're going to get all our transactions. And then we went to a bottom line. We said, well, bottom line here is zero. I don't know anything. Bottom line here, I've got $5,000 sitting in inventory. Not cost of goods sold, because I haven't sold inventory. I've got negative $5,000 in cash. I assume I had some cash already at starting point. So hopefully I have positive cash. Any questions on it? No. When you pay the bill, you're not depleting inventory because it's still here. I got a computer. Here it is. I got a computer right here. I got $5,000 in computers I bought. They're sitting on the shelf. We're going to take it out of inventory when we sell it and move it down to cost of goods sold on the income statement, but not until we sell it. Remember our $25,000 cars we were selling that we paid $20,000 for? I got $20,000 sitting in inventory. Great, that's where it belongs. Until I sell it for 25, then I move it from inventory down to my income statement as cost of goods sold. Now I know I made $5,000. My income statement says so. 25,000 revenue, 20,000 cost of goods. But I'm not going to move it out of inventory until it's sold. It's an asset. It's saleable. I can turn it to cash. I own it. Until somebody else owns it, it's not a sale. So it's ownership, I transfer my ownership. Good question. So we should all be on the same page with that, I hope. So we're seeing our debits, we're seeing our credits, we're seeing how this all flows. Let me go back and let's talk about, I'm going to go through, I'm going to stop my share, go to whiteboard. All right, so we're going to our whiteboard. We're now going to take a look at some more debits and credits. We're having fun with debits and credits. Assets, liabilities, equity. I'm not going to worry about revenue expenses. Here's my balance sheet. I've got 200, I could be $200, $200,000, $200 million, I don't care. I got 200 in total assets, 200 in total liabilities, equity. I'm in balance. We're going to stay in balance. Now, what happens if I had 150 and 50? So I have liabilities totaling $150, let's say, and equity totaling $50. What's that? Totaling 200, yep. And I could have cash, I could have inventory, I could have buildings, I could have land, I could have equipment, I could have all kinds of things for that 200. What is my debt to asset ratio? Good question. Well, what's another word for debt? Looks like liabilities to me. So my total liabilities is 150. Right here. My total assets, and the same as total liabilities equity, is 200. So my debt to asset is 150 divided by 200. Now I can quickly look at that, and if I cut my 200 in half, that's 100. Cut my 150 in half, that's 75. So I've got 75 out of 100. In the chat, here's your attendance question for today. What is my debt percentage or my debt to asset ratio? How much of my balance sheet is debt? Put in a percentage, please put it in the chat. 7 of you, about half responded, just over half. We're good to go. Yep, 75%. So we've got 75% of our balance sheet is debt, which means 50 out of 200. It's 25 out of 100. 25% is my equity ratio. What's my debt to equity ratio? Go ahead and type that in the chat. Debt to equity, no calculators, please. Look at the numbers on the screen and tell me what my debt to equity ratio is, please. Three, four. Debt to equity. So debt to equity looks something like this. Debt divided by equity equals what? 150 divided by 50 equals 3. Thank you. 3 to 1 or 3. 1/3 isn't going to quite do it. All right, so we see that I'm more, the debt to asset tells me a story. And by the way, if I told you, I'm going to make up some numbers here. If I told you I had 50, let's do 50 here and 50 here, and I had 20 and 30, that's 50, and I had 50 here. What's my debt to asset ratio? Well, if I double my 50, I get 100. That means I can double my 20 and get 40. I can tell you right now it's 40%. I don't have to do any fancy calculation. I don't have to use a calculator. The same way I knew when at 200 and 150, I cut it in half, I was 75%. That's just some quick math. And this ballpark math is not a bad habit to get used to. It's not something a lot of people say, it's got numbers, I need a calculator, give me my phone. If you're on an interview and somebody asks you, what's half of 100? You better be able to say 50 without whipping out your phone. One of my marketing professor from the last school I was at, in a marketing interview, he say, I have a $60 item and I need to mark it up 20%. How much would I sell that item for? And he's expecting you to say, well, 60, 20% of 60, that's 2 times 6, 20% would be $12. I add 12 to my 60, that's $72. He would expect you to be able to do that without a calculator, or he wouldn't hire you. And this is a marketing person. Now, this was Smuckers. He was the manager for Asia and Australia, Oceania and Asia. But he would interview folks for a marketing position, and that's the question he would ask. And if you couldn't answer that, you lose. You won't be hired. But that's math. That's if you're selling something, you should know what your markup is. Or your customer says, I'm willing to pay 20% markup. I'm not going to pay any more. You should be able to fairly gracefully come up with that. So be aware, just because you're not an accountant, you'll need to understand numbers, not be afraid of them, be able to use them. All right. So we've got this debt ratio, debt to asset ratio in the chat. Is higher debt or bad? Please pop in the chat your opinion. Is higher debt good or bad? I'll be asked this question before. Most of you have got the answer I would prefer. 2 words. It depends. Some of, yeah, you're right, I'm going to say it depends. Why is higher debt bad? Higher debt is also known as SEM. Somebody else's money. Nice to use somebody else's money. Now, let me ask you the question. Let's say this was just dollars. Now, I'm going to erase a bunch of this stuff. So if I told you that we had a balance sheet that was 199 liabilities and $1 in equity. If I made $1, that would be 100% return, right? I invested $1 and I made $1 and I still own the company. That's a pretty good return. On 200 in assets, if I had 0 debt and I invested $200, I made $1. That's 0.5% return. Put the money in the bank. I get at least 1% now in the bank. So why don't we all borrow money? Well, we've got to pay interest on money. The downside is we have expenses we've got to pay. If you have a loss, if you lose $1 or $2 or $3, now you have negative equity. You're in the hole. And you as an owner might go walk away. You might say bye. And now the debt holders own the assets. The debt holders actually become the equity holders. That's how it works when you go bankrupt. And they hopefully will get paid back. But there may be land, there may be building, there may be equipment, there may be receivables that are going to be paid or may never be paid. But the debt holders hope they get paid, eventually get paid. So with higher debt is higher risk. So now it depends kicks in. Are you wanting to make a higher return? Well, if you want a higher return and you want to borrow somebody else's money, it's a higher risk for failure. If you have a couple of bad years, you're in deep doo-doo. Anybody know how many years Tesla lost money? Nope. They had net losses, not profits. They were founded in 2003. Type in the chat how many years you think they lost money. No, good guesses. 17 every year since 2003 until a week ago Wednesday, they announced their first profit. Would you invest in a company that loses money for 18 years straight? Well, a lot of people bought Tesla. Okay, Elon Musk did pretty well. His net worth is pretty good with his Tesla stock. Now he did show a profit, or they get a week ago Wednesday, they announced it. First time in 18 years, 17 years of losses. Amazon lost money, I think it was 7 years, or it was 9 years. Spotify never made a profit. Lyft, Uber has never made a profit. These are companies that people are investing in. You say, why would you invest in a company that doesn't make a profit? Well, someday they should. I hope they do. And when they do, they better hit it big because I got a lot of money tied up in these guys. And as long as you're pumping equity in there, the cash flow is positive. And they're borrowing money, banks are supporting them because they get enough investors in there that said, yeah, we're going to invest with them. So the whole point is it's a risk reward kind of thing. I want you to be aware of that. Question is, isn't it typically likely to fail if it doesn't make a profit in the first 5 years? You know what my answer is? 2 words. It depends. Typically, it depends how deep your pockets are. If you've got deep pockets, you can support a business for 10, 20 years. You can run losses. Typically, anywhere from 65 to 90% of businesses will fail within 10 years. So that's the standard. That's the Bureau of Labor Statistics, 65% will fail. I've heard it as high as 90 from some other sources. That's a high failure rate. 2/3 odds are against you. Now, can you survive? Depends how deep your pockets are or how much money can be pumped into the business. But if you continually have losses, people may not want to invest. So that's a good question. Fair question. Let's go talk about some more journal entries. I want to go in and all right. So if we're looking at our business, we're trying to figure out if we are making money, losing money. A couple of things are going to go on. Let's go back and I'm going to erase some of this stuff. And we're going to talk about the more entries. So what's going on here when we do our journal entries? We went through a series of journal entries before, and we went ahead and we bought inventory and we paid for the inventory. Or maybe we prepaid insurance, one asset up, one asset down. But we're going to go through and what happens with wages at the end of the month. Let's say we pay our wages on January 2nd. Twice a month. So we have 2 weeks in December of wage expense that we haven't paid yet. We haven't written the check. But as a business, we need to record those 2 weeks of expenses. So let's say I had $5,000 in wage expense. And I'm going to put the wage expense here. If I was writing a check, I would credit cash for $5,000. But I can't do that. I'm going to have a liability called wages payable. We're estimating here. We're going to go with, and we're going to call these, we're going to accrue estimate. We might have taken out a note on December 1st, 90-day note. Well, December, January, end of February, you got to pay the note plus interest. Nobody's sending us a bill for that interest. But we're going to have to accrue our interest. So we're going to estimate or accrue interest expense. We're going to have something called interest payable. Maybe that's $6,000. So we've got some estimates going on here. How about end of the month? Well, let's say we bought insurance. We spent $24,000 worth of insurance on December 14th. So how do we do a journal entry? 24,000, 24,000. Did cash go up or down when we bought the insurance? Went down, so we're going to credit cash. And what are we going to debit? Well, in this case, it's called prepaid insurance. These are both assets, right? Cash is an asset, prepaid insurance is an asset. We haven't used any insurance up. If we cancel our policy on December 26th, we get our money back for next year's insurance. But what's going to happen on January 31? We're going to have to come up and amortize or come up with an adjustment. Let's see, 12 months, 24 total, that's $2,000 a month. So we're going to have to come up with an adjustment of 2,000 and 2,000. January 31, we're going to have an expense called insurance expense. And we're not paying cash. We already paid the cash in December. So we're going to reduce our prepaid insurance by $2,000. So when all is said and done, our cash account is already covered here. I paid 24. And my prepaid insurance, 24. From this entry, I've got insurance expense here. So what happens? I'm going to take $2,000 and credit my prepaid insurance and debit my $2,000 on insurance expense. That's interesting. So what you're telling me is I don't spend any more cash. I paid the cash in December. But at the end of January, I have to adjust this account. The technical term is not an accrual. These are called deferrals. And the whole thing that we're talking about doing here, the term we're using are called adjusting journal entries, or AJEs. A journal entry that's done at the end of a time period, month, a quarter, a year, typically. And those adjusting journal entries are going to either be estimates, we're going to accrue. I know I've got some wages I owe. I know I've got some interest I owe. I know my marketing team went out and was selling in December. I don't get the travel expense reports. They don't submit it. They're not due till the end of January. So I got to estimate in December how much they spent. They spent $25,000 entertaining clients, traveling out, traveling the world and entertaining and selling and whatever they were doing in December. I got to make an estimate. That's an accrual. Or I've prepaid monies, or maybe I have earned revenue. What's going on? I might have had some revenue that I have unearned revenue. Go through, I'm going to here. And I'm going to make another journal entry because I got a deposit. I'm an accountant or an attorney or an architect, and a customer gave me cash to the tune of $20,000. And I haven't done anything. I have a liability called unearned revenue, $20,000. And at the end of the month, I look down at it and I say, well, you know what? I've done about $15,000 worth of this stuff. So I'm going to have to put in a journal entry for $15,000 and $15,000. Now, They didn't send me any more money. I can't do any cash adjusting here. But I'm going to remove from my unearned revenue, my liability of unearned revenue of 15,000, and I'm going to put in, we'll call it maybe service revenue. I'm going to move it to my income statement. So I'm moving things from my balance sheet to my income statement. I'm clearing out because I did the work. I don't owe that 15,000 back to the customer anymore. If they cancel, and right now I've done 15,000 worth of work, I still owe them 5. Typically, we'll get that 5,000 when we do some more work. But until we do that work, I can't record it as revenue. So our whole point of adjusting journal entries, just abbreviate it now, AJEs, adjustments at end of the time period. Now, there are 2 other things that are unique about AJEs. One is always one balance sheet and one income statement account. Notice I've got my expense and my prepaid insurance. Prepaid insurance is an asset, insurance expense is the income statement. I got my wage expense and wage payable. Again, one's on the income statement, one liability in the balance sheet. Interest expense, interest payable. Unearned revenue and service revenue. One service revenue is on the income statement, unearned revenue is on the balance sheet. And one other thing to remember, I'm going to put this one in red. I'm going to put it in capital letters. Never cash. Cash is not an AJE. You say, wait a minute, I can adjust my cash, can't I? Spent some money. That's going to adjust cash. And the short answer is yes. But that's not an adjustment to cash. That's a journal entry in cash. I spent some money or I got some money. The adjustments are deferrals and accruals, estimates and stored monies. The cash came in before, or the cash is going to come in later, or the cash went out before, or the cash is going to go out later. My wages, I'm going to pay that later. My interest expense, my prepaid insurance, I already paid that. My unearned revenue, well, I already got the money for the revenue. I am not adjusting cash. Never ever on an adjusting journal entry, end of the month. I'll be clear. You'll be reading more about this. You'll be seeing more about this. And this is part of the homeworks, the readings, and we'll be good to go. All right. A couple other things to talk about. Let's go ahead and I'm going to go back and share. So you all see the counting period on here? So we have that artificial time theory thing going on. I want to talk to you about that. By the way, quarterly, you say quarterly is 4, right? No. Quarterly is 3-month period. It's 4 quarters in a year. So January, February, March. January 1st, March 31, August. April 1st, June 30. July 1, September 30. October 1, December 31. I want to talk to you about number of days in a month. I don't want you to be embarrassed. You tell somebody I've got a December 30th year end or a June 31 year end, you will embarrass yourself because there's not 31 days in June. And typically, there might be a December 30, but typically it's the last day of the month, so it's a December 31 year end. And I want to remind you, because some of you say, well, I get confused behind that, and that's okay. 2 ways to remember it. I'll show you the knuckles and I'll show you the rhyme. The rhyme was 30 days has September, April, June, and November. Those are all the 30-day months. All the rest have 31 except for a leap year, February. Or the knuckles. Let's count some knuckles. January, 31. February, funky. March, 31. April, the valley, 30. May, 31, my birthday. June, 30. July, 31, the knuckle. Now let's match the knuckle. August, 31, the knuckle. September, 30. October, 31. November 30, December 31. Okay, so if you can count your knuckles, or you can remember the rhyme, you can handle number of days in the month. But if you tell me there's 31 days in June, we're gonna have a conversation. And remember, there's one, we talked about it, 13 equal 4-week periods in a year. Said restaurants might want to have 4 Fridays, 4 Saturdays, 4 Mondays, 4 Tuesdays, just to be consistent. But here, quarterly, 3 months, monthly, semi-annual, twice a year, annual. That's the breakdown in years. Any questions on that? On the same page. Last thing I want to talk about is accrual versus cash basis. Well, second to last thing. Accrual basis. When we're doing accrual basis, not accrual accounting, but accrual, we have cash versus accrual. Cash basis is what the IRS and individuals are when you pay your taxes personally on your 1040. What do you mean? Okay, so if I don't get paid till January 2nd, I am not going to have that on my W-2 for last year. That's going on next year's W-2. But the business is going to accrue that wage expense and include it in December, even though they haven't paid it yet. So their accrual basis, and personally I'm cash basis. That's why a lot of people December will rush to pay their property taxes, or rush to go buy glasses, or medical expenses. So they want to get deductions in the year that pay them. So individuals are on a cash basis. But the accrual basis is important to understand, because what's going to happen? When you are reporting, let's say this is our revenue, these are expenses. In December, I get paid $20,000 in revenue for a project I do in January. If I write a check for $18,000 in January versus December, you'll say, "Oh, I got $20,000 in revenue. Great." And then you go next year in January, I'm losing $18,000. You really should, on an accrual basis, have that 20,000 here to match it. That's why we have this prepaid, we have this unearned revenue. That's why we're balancing all this out. So we'll talk more about accrual and cash next round, but I wanted to give you the big picture. Cash is just when cash comes in, it's revenue. Cash goes out, it's expense. There's no receivables, there's no payables on a cash basis. So it's all about the cash coming in, the cash going out. Accrual basis has receivables, has payables, has unearned revenue, has prepaid expenses like insurance. On that note, I'll ask for any questions, and I will set you free. Comments or questions? And I wish you a happy Monday. See you soon.
Have a good day.
You too. Thank you.
You too, thanks.
Appreciate it. Take care.